Hello, and welcome to the 16th lesson of Chapter 6. Today, we are diving into the world of Forex margin trading. We'll be covering a glossary and quick reference guide. We're about to embark on a fascinating journey, where we'll demystify complex terms and make sense of the intricate world of margin trading in Forex. Our voyage will sail through 6 key ports of interest. First, we'll anchor at margin trading terminology, defining crucial terms like margin, leverage, margin call, and stop-out level. Next, we'll cruise towards the intriguing realm of leverage, explaining its workings with practical examples. We'll then dock at margin requirements, detailing how brokers set and calculate these. Our fourth stop will be risk management and margin trading, where we'll explore how to navigate the choppy waters of trading risks. Then we'll visit common scenarios in margin trading, offering realistic scenarios of different market conditions. Lastly, we'll wrap up with a comprehensive glossary of terms for quick reference. So, buckle up as we start with margin trading terminology. First, we'll define key terms in margin trading such as margin, leverage, margin call, and stop-out level. Let's begin with the term margin. In the world of Forex trading, margin is the deposit required to open and maintain a position. Think of it as collateral for a loan. This loan is the leveraged amount you borrow from the broker to trade larger positions than your capital would otherwise allow. Next up is leverage. Leverage in Forex trading is like a double-edged sword. It can magnify both profits and losses. It's essentially a loan provided by the broker that allows traders to control larger positions with a smaller amount of funds. For example, a leverage of 50-to-1 means for every dollar in your account, you can control up to $50 in the Forex market. Now let's talk about margin call. This is a warning from your broker that your margin level has fallen below a specific threshold, usually set at a certain percentage. It's the broker's way of saying, hey, your account is running low on funds and you need to deposit more money or close some positions to meet the margin requirements. Finally, we have the stop-out level. This is the point at which the broker starts closing your open positions because your account equity has fallen below the required margin. It's a safety net to prevent your account from going into negative balance. Understanding these terms is like learning a new language. It might seem a little overwhelming at first, but with practice and familiarity, you'll soon be speaking the language of Forex trading fluently. With these terms clarified, let's move to understanding how leverage works in Forex trading. Now we delve into the workings of leverage in Forex trading. Imagine walking into an electronics store with just $100 in your pocket, but you walk out with a $1,000 gadget. Sounds like a fantasy, right? Well, in the world of Forex trading, this isn't just a dream, it's called leverage. Leverage is a tool that allows traders to control larger positions in the market with a smaller amount of actual capital. It's kind of like a loan provided by your broker, enabling you to amplify your trading potential. Now, the amount of leverage you can use is expressed as a ratio. For example, if a broker offers a leverage of 50-to-1, this means you can control a $50,000 position in the market with just $1,000 of your own capital. It's important to remember, though, leverage is a double-edged sword. While the potential for profits is magnified, so too are the potential losses. If the market moves against your position, you could lose more than your initial investment. Let's illustrate this with an example. Suppose you have $1,000 in your trading account and you decide to trade without leverage. If the price of the currency pair you're trading increases by 1%, you make a profit of $10. However, if you were to use a leverage of 50-to-1, that 1% increase would translate into a $500 profit. Sounds great, right? But remember, if the market had moved in the opposite direction by 1%, you would have lost $500, half of your account. So, while leverage can boost your profits, it can also amplify your losses. It's a powerful tool, but like any tool, it must be used with caution and understanding. Now that we understand leverage, let's discuss how brokers set and calculate margin requirements. Margin requirements are a critical component of Forex trading. Here's how they work. Margin requirements are essentially a security deposit, put in place by your broker to ensure they're covered in case things go south. This deposit is a fraction of the total value of your trade, so imagine you're trading with a leverage of 100-to-1. This means you only need to deposit 1% of the total trade value. This 1% is your margin requirement. Now, how are these requirements set and calculated by brokers? Well, it's not a random process. It's carefully calculated based on the leverage offered. For instance, if a broker offers you a leverage of 200-to-1, your margin requirement would be 0.5% of the total trade value. Similarly, at 50-to-1 leverage, the margin requirement would be 2%. It's important to remember that different brokers may offer different leverage levels, and hence different margin requirements. Some brokers might offer a more generous leverage of 400-to-1, meaning your margin requirement would only be 0.25%. Another crucial point to bear in mind is that margin requirements are not fixed and can change. This change is usually dictated by market conditions. In times of high market volatility, brokers may increase margin requirements to protect themselves and their clients from sudden market shifts. So, what are the implications for traders? Well, the higher your leverage, the lower your margin requirement, and the more you can potentially profit from small price movements. But remember, higher leverage also means higher risk. If the market moves against you, you could end up losing more than your initial deposit. In conclusion, understanding margin requirements helps you grasp how much you need to set aside for each trade and helps you gauge your potential risk and reward. Understanding margin requirements is crucial, but so is managing the risks associated with trading on margin. Scene script. Trading on margin can be risky. Let's discuss how to manage these risks effectively. Firstly, it's vital to understand that margin trading is not a gamble, but a strategic financial decision. To ensure you're making informed decisions, you need to stay updated about market trends, news, and economic indicators. This knowledge will enable you to predict possible market movements and adjust your trades accordingly. Secondly, diversification is key. Don't put all your eggs in one basket. By spreading your investments across various markets, you can balance potential losses in one market with gains in another. This strategy can help in reducing the overall risk. Thirdly, use stop loss and take profit orders. A stop loss order automatically closes your position if the price reaches a certain level of loss. On the other hand, a take profit order secures your gains by closing your position once the price reaches a predetermined profit level. These tools can help you manage risks and protect your capital, even when you're not actively monitoring your trades. Fourthly, don't over-leverage. While leverage can amplify your profits, it can also magnify your losses. It's crucial to use leverage wisely, based on your risk tolerance and trading strategy. Remember, the goal is not to make a quick fortune, but to ensure steady, long-term profits. Fifthly, always have a risk management plan. This plan should outline your risk tolerance, trade size, and the maximum loss you're willing to bear. Stick to this plan regardless of how tempting a trade may seem. Lastly, remember to continually educate yourself. The world of Forex is always evolving, and so should your knowledge. By staying informed, you'll be better equipped to handle the risks associated with margin trading. Risk management is vital, but it's also important to understand how margin trading works in different market conditions. Let's delve into some common scenarios in margin trading. Imagine you are a trader and you've decided to invest in the Forex market using margin trading. You've got $1,000 in your trading account, and your broker provides a leverage of 50-to-1, so your total buying power is now $50,000. In the first scenario, let's say you've made a smart move. The currency pair you've invested in has risen in value by 2%. Based on your leverage, that 2% translates into a 100% return on your original margin. You've just doubled your money, turning your $1,000 investment into $2,000. But it's not always sunshine and rainbows. In another scenario, the currency pair you've invested in falls by 2%. This time, that 2% loss translates into a complete loss of your original margin. You've just lost your entire $1,000 investment. Now consider a third scenario, where the market fluctuates wildly. The currency pair you've invested in first rises by 2%, then falls by 2%, and then rises again by 2%. If you were quick enough to close your positions at the right moments, you could have made a profit each time the market rose. But if you held onto your positions, you would have ended up breaking even, despite the market's wild swings. And finally, consider a fourth scenario where the market stays flat. Despite your high leverage and large buying power, you make no profit and no loss. Your $1,000 investment remains $1,000. These scenarios illustrate the potential profits, losses, and risks in margin trading. The key takeaway is that, while leverage can significantly amplify your profits, it can also rapidly deplete your trading account if the market moves against you. Now that we've covered these scenarios, let's wrap up with a glossary of terms. Finally, we present a comprehensive glossary covering various terms and jargon used in Forex margin trading. This quick reference guide will enlighten you on the wide-ranging terminologies used in this sphere. Let's dive right in. First up, margin. It's the amount of money needed in your account to maintain your open positions. Think of it as a good faith deposit that you put up to keep your trades open. Next, we have leverage. This is a tool that lets you control larger amounts of money with a smaller deposit. It's like a magnifying glass for your trading capital, amplifying potential profits but also potential losses. Then there's the margin call. This isn't a call you want to receive. It's a warning from your broker that your account has fallen below the required maintenance margin. It's a wake-up call to either close some positions or deposit more funds. The stop-out level is another term to be familiar with. It's the point at which your broker starts closing your open positions to prevent further losses. Consider it as a safety net protecting you from sinking further into the red. PIP is a term you'll hear a lot. It stands for point in percentage and is the smallest price move that a given exchange rate can make. And then we have the bid price and ask price. The bid price is the highest price a buyer is willing to pay for a Forex currency pair. Conversely, the ask price is the lowest price a seller is willing to accept. Last but not least, spread. It's the difference between the bid and ask price and is essentially the cost of trading. These are just a few of the terms you'll encounter in the world of Forex margin trading. With each term, you're building a solid foundation to navigate this complex yet exciting market. With this glossary, you should now have a solid understanding of Forex margin trading. Congratulations on completing this lesson on Forex margin trading. We've journeyed together through the intricate world of Forex margin trading, and I trust you've found this expedition enlightening. The terrain we've covered has ranged from the foundational elements of margin trading terminology to the thrilling heights of leverage and the essential considerations of margin requirements. Remember, a solid understanding of these key terms is your compass in the Forex trading world. They will guide you in your trading decisions, helping you navigate the volatile seas of the Forex market. Like a seasoned sailor, knowing the language of the seas makes the journey less treacherous and more rewarding. We delved into the mechanics of leverage, exploring how it amplifies your trading capacity. It's like the wind in our sails, allowing us to traverse vast financial oceans with little capital. But, as with any powerful force, it must be harnessed wisely. We also discussed margin requirements, the safety net set by brokers to ensure we don't sail too close to the wind. Understanding these requirements is akin to knowing the depth of the water beneath your ship. It can keep you from running aground. Risk management in margin trading is another critical topic we covered. No voyage is without its perils, and Forex trading is no exception. Implementing sound risk management strategies is like keeping a vigilant lookout. It can help you avoid potential hazards and keep your trading journey on course. We then ventured into common scenarios in margin trading, practical illustrations that serve as your charts and maps. These examples provide a clearer picture of how the concepts we've covered work in various market conditions. Finally, we compiled a comprehensive glossary of terms, your quick reference guide in the vast ocean of Forex margin trading. This glossary is your trusty almanac, ready to clarify any term that may seem foreign in your trading journey. Now I encourage you to complete the lesson and start the final lesson of this chapter, strategies to prevent margin calls in Forex trading. Until next time, happy trading.